money usually moves out of the market. It goes into cash, it goes into liquid assets, it goes into gold, and usually it also goes into the US dollar.
$250 billion of supply. And that's up so much year over year. I mean, the growth has been really exponential. You're talking about just over a year ago, $100 billion.
But it's the interaction of all of these uncertainties. And I think that there's this hoped for, if things deteriorate and if the price of oil were to spike.
While Washington grapples with soaring borrowing costs and mounting fiscal pressure, something even more dangerous is happening. Its closest allies are walking away. No press conferences, no loud declarations. Just one number, $36 billion worth of U.S. Treasury bonds sold off in just 30 days. And the sellers, not rivals like China or Russia, but Canada and the European Union, the very nations that once helped architect the U.S.-led global financial order after the Cold War. As the bond exodus accelerates, yields on 10-year Treasuries are now flirting with 7%, a level not seen since the early 2000s. The U.S. dollar long, the world's dominant reserve currency, is now slipping. IMF data shows its share of global reserves falling below 55% for the first time in history. Quietly but deliberately, the pillars of post-war financial loyalty are cracking. And the message behind it all, America is no longer too big to doubt. Because when Ottawa and Brussels start cashing out, the rest of the world starts asking, is the U.S. still the safest bet or just the loudest? This isn't a trade war. There are no tariffs, no fiery speeches, no sanctions. But make no mistake, a financial rebellion is underway, and it's coming from within the West itself. The retreat from U.S. debt isn't loud, it isn't public, but it's damning. America's closest allies are no longer showing up to the auctions, not because they've declared opposition, but because they've lost faith. Instead of confrontation, they've chosen something more subtle and far more effective. They've simply stopped buying U.S. Treasuries. And in the world of high finance, that's a far sharper punishment than any import tax. It's a vote of no confidence wrapped in silence, and the first country to pull the trigger. Canada, the neighbor, the longtime trade partner, the one that always stood by Washington's side in G7 meetings and global financial summits. Not anymore.
We now have a trade war. We also have Trump's tax cut bill.
The Congressional Budget Office projects this bill would create more debt.
The bond market, and particularly U.S. Treasuries, are no longer as safe.
Now, by reducing its Treasury holdings, Canada has sent a message the market can't ignore, one that's being echoed quietly but unmistakably across Brussels and beyond. This isn't about breaking alliances. It's about recalibrating risk. And right now, the biggest financial risk is the United States.
U.S. Treasuries have been Wall Street's rock-solid bet during times of turmoil, but now they're starting to trade like risky assets. And that's a warning to President Donald Trump.
In March 2025, a single sentence from Donald Trump triggered more than just diplomatic discomfort. Speaking at a rally in Ohio, the former president declared Canada needs to start acting like part of the United States. To some, it was just more political theater. But in Ottawa, the message landed differently. It wasn't the insult itself that stung, it was the assumption that Canada's loyalty, both political and financial, was automatic. That assumption didn't just provoke outrage, it provoked action. There were no fiery speeches, no dramatic trade threats. Instead, Canada responded where it mattered most, in the bond market. Within weeks, the country's largest institutional investors moved in quiet unison. The Canada Pension Plan Investment Board, the Ontario Teachers' Pension Plan, and CDPQ Caisse de dépôt et placement du Québec announced that they would begin reducing their exposure to U.S. Treasuries by 10% over a 3-year horizon. It was a clear, calculated step away from dependency on American debt. And it came with a message. We're not building our financial future on another country's deficit, said Canada's finance minister in a rare direct comment. That line didn't make global headlines, but it sent a ripple through every trading desk that deals with sovereign bonds. Because this wasn't just a portfolio adjustment, it was a political decision disguised as risk management. And it wasn't just about diversification, it was about sovereignty. For decades, Canadian funds, public and private, have treated U.S. debt as the ultimate safe haven. But that assumption relied on one key pillar: trust. Trust that Washington wouldn't weaponize its economic power against its closest partners. Trust that the global financial system built on dollar dominance would stay predictable. Trump shattered that trust, and Canada took note.
Canada holds about $300 billion in U.S. bonds, which is essentially United States Treasury debt. That 36 trillion in debt that the US has, we hold about 300 billion of that in the form of bonds. US bonds are considered to be one of the most safe investments in the world. Usually when the stock market is crashing, investors will pull their money out and they'll invest it into US bonds.
What truly unsettled Washington wasn't the size of the sell-off, it was the organization behind it. This was the first time since 1987 that Canadian sovereign-backed funds openly coordinated a shift away from US financial instruments. There was no panic, no sell-off spike. Just steady, methodical repositioning, the kind that sends one clear signal to markets: we're hedging against America. To Washington, Canada had always been a reliable junior partner, sometimes mocked as the 51st state. But this move marked a turning point. Canada wasn't rebelling loudly. It was seceding quietly from America's financial shadow. And in many ways, that's more dangerous. Because when your closest ally stops believing in your fiscal house, it's not just your interest rates that rise. It's the question marks hanging over your entire global leadership. Canada's pivot away from U.S. debt is not just a market correction, it's a financial reorientation, one that signals deeper strategic intent. After President Trump's sharp March 2025 remarks claiming Canada needs to start acting like part of America, Ottawa didn't engage in diplomatic theatrics. Instead, it responded with capital flight. Behind the scenes, the shift was coordinated and deliberate. The Bank of Canada began trimming its U.S. Treasury exposure, while provincial pension giants like the Canada Pension Plan, Quebec's CASE, and the Ontario Teachers Fund announced a gradual 10% reduction in U.S. holdings over the next 3 years. At the same time, Canadian financial institutions began reallocating into domestic bonds and euro-denominated assets, creating what analysts now call a monetary buffer against Washington's volatility. Commercial banks didn't mince words either. They described the shift as financial diplomacy insurance, a move designed to shield Canadian portfolios from the growing unpredictability of U.S. policy swings. In Parliament, this realignment received rare bipartisan support, with legislators backing initiatives to decouple investment ecosystems from U.S. dependency and reinforce local capital markets. It's the most significant diversification away from American debt by Canada since 1987, and Washington has noticed. Because this isn't just about risk management, it's about sovereignty. Canada is signaling that it no longer trusts U.S. financial stability enough to peg its future to it. And just as the U.S. starts feeling the chill from the north, another front quietly opens in the east. Europe is following suit, but with even fewer headlines and far more surgical precision. While media headlines were glued to the theatrics of the G7 summit, another story was quietly unfolding across Europe's financial capitals, from Paris to Frankfurt, from Amsterdam to Zurich. Central banks and sovereign funds weren't issuing fiery speeches, they were issuing sell orders. In recent months, Europe's surplus economies, Germany, the Netherlands, Luxembourg, and Switzerland, have all been gradually reducing their exposure to U.S. Treasuries. But this wasn't a panic sell-off. It was a disciplined, coordinated retreat. And the reason wasn't just yield-related, it was strategic. Currency hedging costs, especially for dollar-denominated assets, have surged. As the European Central Bank continues easing while the U.S. Federal Reserve holds rates higher, the interest rate differential has made it increasingly expensive for EU institutions to hold U.S. debt without bleeding value. The math simply stopped making sense. Holding U.S. Treasuries no longer offered safety. It became a liability. For most European countries, the move was framed as financial housekeeping. No statements, no declarations, just a slow exit signal enough for those paying attention. But France took it a step further. In Paris, policymakers began linking bond divestment directly to political grievances, disagreements over digital taxes, trade imbalances, and NATO contributions. In effect, Europe didn't need to confront Washington with sanctions or tariffs. It simply withheld its trust and its capital. And in the global financial system, trust is the real currency. As capital flows quietly realign, Washington now faces a new kind of isolation, one that isn't loud but is far harder to reverse. When Washington kept tariffs in place on European electric vehicles and agricultural exports, Paris didn't retaliate with counter-tariffs or press statements. It retaliated with capital. The French Ministry of Finance quietly cut its holdings of U.S. Treasuries to their lowest level in over 12 years. An advisor at the Élysée Palace put it bluntly: you can't negotiate fairly with someone while funding their debt. It wasn't just retaliation, it was also fiscal strategy. The funds previously locked in U.S. debt were redirected toward France's own public debt, and green investment plans giving the Macron administration more political room to maneuver at home. And in that act lies the real message: allies don't weaponize money against each other. When financial trust breaks even silently, the entire alliance shifts. Right now, the U.S. Treasury is issuing over $110 billion in bonds every month, a pace that assumes one thing: that global buyers, especially allies, will keep showing up. But what if they don't? What if just 20% of that foreign demand vanishes, as it's already beginning to? The impact wouldn't just be technical, it would be seismic. To fill the gap, the Federal Reserve would likely be forced to step back in expanding its balance sheet and resuming large-scale purchases. That's a move markets read as inflationary, and in today's fragile economy, even the hint of inflation can trigger panic in both consumer confidence and investor sentiment. Next, the U.S. Treasury would face a dilemma: either issue more short-term debt to keep rates down, exposing the country to rapid refinancing risks, or lock in higher interest costs for longer-term stability. Neither option is cheap, neither is politically painless. And here's the kicker: every 1% increase in borrowing costs translates into over $300 billion in annual interest payments. Money that doesn't build roads, fund schools, or support veterans. It just services the debt. A silent tax on future generations. This is no longer a hypothetical. It's unfolding in real time. If trusted allies like Canada and France are rebalancing their reserves, pulling quietly away from U.S. bonds, the message is clear: confidence is fading, and fast. And in a global economy where debt is the backbone of power, trust is the oxygen. Lose it, and even the strongest empire starts gasping for air. Because if America can't count on its closest friends to finance its future, the uncomfortable question becomes: who's left to fund the world's most indebted superpower? It's not China, it's not Russia. The most serious challenge to the US dollar isn't coming from geopolitical adversaries, it's coming from friends, from Canada, from the European Union, from allies who once co-wrote the financial rules of the post-Cold War order. They're not waging war on America, they're protecting themselves from the risks of being too exposed to it. There are no slogans, no fiery speeches, just capital moving quietly, strategically, and deliberately. And when the very countries that once carried America's debt are now stepping back, the question becomes impossible to ignore. If even your closest allies no longer trust the system, why should anyone else? So what happens next? What will Washington do when its most loyal bondholders walk away? And here's a more personal question. If you had a few $100 million in reserve, would you still hold it in US dollars? Let us know in the comments, and don't forget to like, share, and subscribe for weekly breakdowns on the hottest global finance and geopolitical moves. Because what's unfolding now isn't just a market shift, it's a global reset, and it's already begun.